Well, for more on the broader markets, let's bring in Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Managers Solutions. Jack, nice to speak with you again. Thanks for making time for us this afternoon.
Well, thanks for having me back.
So what do you make of, the sort of year so far, the focus of investors so far this year? It seems like it was very heavily on interest rates and the trajectory and the possibility of cuts, but now shifting more towards our earnings season as we do get these results coming out. Back to interest rates next week when we hear from the Fed?
Yeah, I think you were running through the checklist there earlier. It's going to be the economic data, it's going to be the Fed, and it's going to be earnings. And a lot of the economic data that's already hit has been fairly supportive. You have the inflation numbers that I think are supportive. That leads right into what the Fed is probably going to say as, talked a little bit tough on inflation, but I think the green light is there for them to begin cutting. Whether they choose to go at the next meeting or whether they wait to maybe the May meeting to do that, we'll see. And then the last one, earnings, which kind of ebb and flow, and maybe you could best characterize them as good enough right now.
Would that make a big difference for investors if the Fed were to cut in May versus in March?
I think at the margin, maybe there's a little bit of a knee-jerk reaction initially, but the two things that I think are the most important factors here: one, economic growth, we don't expect to precipitously fall off the table, and that's going to be a net positive. And then two, the fact that the Fed is no longer hiking, I think, is the more important takeaway there. Whether they hike 3 or 4 times or 6, or they start in February, or they start in May, I don't think that's the bigger point here. I think the bigger point is the Fed is actually stepping off the brake and moving to an easing backdrop. That's the more important factor here.
Where do you see, points of strength when you're sort of looking across the U.S. economy for 2024?
There's certainly a bunch of places that we focus on that are very supportive, but I think maybe the bigger one, if we continue to believe that the inflation rate is going to head down to that 2% target by maybe even as early as summertime, rates should probably follow suit on the back of that. And as rates push lower, you're probably going to see mortgage rates following suit, and that's just going to jumpstart the housing economy. And so when you think about residential construction, everything that goes along with building a new house, you have to furnish it. All those ancillary things put together, that's about 20% of GDP right there. So as the economy slowly slows, that's our base case scenario here, rates push lower. The offset to that is probably going to be a reacceleration of the housing market, which is a nice little offset there. So that's really our biggest, tailwind that we expect for the rest of this year.
I wonder what you're thinking for the broader equity markets. I'm just taking a look at the S&P 500, and when you look at January, I know it's up 2.5%, but it has been, other than the past 6 days, which were all gains, but some very small ones, right? It's not necessarily huge moves happening. A little retracement here, forward, moving forward here or there. So I don't know. It doesn't really seem like it's full steam ahead. Do you think that investors should be prepared for more of that to come? Like, do you see it being a clear path, or what do you see ahead, Jack?
Yeah, our 2024 outlook thought that we would see some chop here in the first quarter. We would probably trade in a range, but I would also say that any sort of significant pullback, anything 7 to 10%, we would say come back in and be buyers on the dip there. But I think there's still a little bit of uncertainty with regard to the economic backdrop, whether it be like you said, the rate cuts, the Fed, the inflation backdrop, will inflation remain sticky? Let's see how earnings are starting to play out. I think once you get through this first quarter, I think there's be plenty of uncertainty that gets certainty, so that sort of obscuredness will sort of fade away. And that's when I think you're going to start to see people becoming a little bit more confident. And our guess would be that recession backdrop slowly starts to fade away even more. And I think that's where you're going to get a little bit more momentum coming back into the equity market. So not surprising with some of the uncertainty still lingering in the first quarter, some chop. But I think that'll give way to an uptrend here in the second quarter. So
right now you prefer large cap stocks in the U.S., Jack, and you see some potential for small cap sort of as things evolve?
Yeah, and I think again this goes back to that sideways chop and a little bit of that uncertainty. I think that prefers us to lean into high quality growth. So we find a lot of quality growth in the U.S. large cap area, and specifically in a lot of those large cap tech names. But again, as the economic uncertainty and a lot of those clouds that are sort of hovering over right now begin to clear up, and we have more clarity, that's when I think you probably would start to see a little bit of that breadth widening out in the markets. And that's where we would expect to see maybe a little bit of a rotation away from that large cap equity trade into the SMID and specifically the small cap portion of the market. And you can even broaden that out and call it, let's say, cyclical value, if you will, starts to maybe get a bid here.
Yeah, so in the second half, you're thinking industrials would be a good sector to be in?
Yeah, and I think the issue there is that we're slowly slowing. That starting point matters, right? If you go back to third quarter GDP at 5%, fourth quarter at 3.3, big difference slowing from that higher level back to trend. And a trend is 1.8%. We still think you're probably going to end up with a 2 handle on GDP growth for the U.S. economy. So you get a little bit of the slowing and maybe a marginal reacceleration. And just simply look at PMIs. When you follow manufacturing in PMI and you overlay industrials, for example, on top of that, they move pretty much in sync. So as that modest reacceleration in PMI, we think will be a net positive for the industrial sector. So that's one of the things we like for the back half of this year.